Isn't Bud amazing?
Yes.
He's world class. I've listened to Bud train multiple times, and I come away with pages of notes every time. Then I go home and tell my wife all the stupid things that we've done that we need to fix. So, I don't know if any of you feel that way, but I felt that way as I listened to Bud train. Bud and I go way back, just to get personal with you. I moved in 1999 to my house and quickly met Bud. He lived in kind of an adjoining neighborhood. We kind of ran in circles at church and in the neighborhood and different things. And then lo and behold, we crossed professional paths quite a few years later. He's a great guy, great man. I'd just like to welcome you to our office. It's great to have you here. You picked January thinking it would be cold. Somehow you brought in 50-degree weather with you, so we appreciate that. Although it's going to snow Thursday, we'll probably be out of here before that happens. If you get a chance, get up to Sundance Ski Resort. Just right up the canyon here. We've got a great restaurant up there. Don't go to the tree room, go to the Foundry Grill, and I promise you won't regret it. It's a great place to be. We love having you in our office. It's great to put faces to names and to have you here and to be with you. My goal today is to kind of set us on the right track for just a minute here with some tax stuff. We're going to spend maybe the next hour and a half to 2 hours talking some tax stuff. I hope that's okay with you. And then we have some other great things. One thing though that I want to make mention before I get started is I brought, hey Will, are you out there? Will's sitting with the client, I think. I brought down one of our senior tax planners here for just a minute. He's sitting right out the door. I say for just a minute, he's going to be here the rest of the day. So Will's sitting right outside the door. If any of you have some specific questions, you want to pick his brain for a minute, just one-on-one, you can grab him, he'll be at the table the rest of the day, and we'll have him around tomorrow too, so we'll make him available to you guys. I want to give you maybe just a little bit of a background to Tax Hive and to this event, if that's okay. As I think most of you know, Kevin O'Leary is my partner in Tax Hive. He's an actual equity owner, he's not just a pretty face. He actually owns part of Tax Hive. And we had done business with Kevin, me and my investors had done business with Kevin in the previous business. And we shut that business down. When we launched Tax Hive, we wanted to talk to Kevin about being part of it. We were business owners. We kind of had a side tax business going, but it wasn't our main focus. And as small business owners ourselves, we had a business doing a couple $100 million a year. It was really hard to get serviced on the tax side as a small business owner. I can tell you some horror stories of my mom's best friend's sister's nephew's dog who I was recommended. It didn't go too well. And I didn't want to pay for the big four. They weren't interested in us. And we kind of had our own struggle with taxes. And so that was kind of the impetus of starting Tax Hive. So we got time with Kevin. We flew down to Scottsdale. And I think you ever been to J.W. Marriott in Scottsdale? It's great, especially this time of year. Get away, get around the dolphins. It's a really nice place. And we had lunch with him. We had this small window with Kevin, to meet with Kevin, to pitch Tax Hive. You know, I worked it up probably a little bit more in my head. I'd seen Shark Tank enough time to be just scared enough to get in front of Kevin, right? So I prepped, I knew my numbers, I understood everything that was going on in the business and everything that we needed to accomplish. So we get down, appetizers come out, we have some food, it comes time to pitch. And I'm there with my partners, with my investors, and I start pitching Kevin. And I'm not 3 minutes in and Kevin does this. Just stop. And like an idiot, what do? I double down. Right? No, Kevin, you gotta listen. There's a plan. Chris, stop. Oh no, I blew it. I blew this. And he goes, Chris, I'm in. Like, that's it. This is a lot different than Shark Tank, right? This is wow. Or maybe I was just that good. I don't know. I don't think it's that. What came from it is Kevin told me, he said, Chris, I've actually owned a tax business before, which I didn't know that. We didn't know that going into it. And he said, I love what we did to help small businesses. And just so you know, we're putting all of us in small businesses that are under a few $100 million a year. Okay? So even if you're here doing $30 million a year, I'm still going to call you a small business. I hope you don't take offense. And so he was on board, but he gave me kind of one mandate in that very first meeting. He said, listen, the reason I'm in is I'm a believer in entrepreneurs. I'm a believer in what they do in this country. I'm a believer in what comes from business owners. and I want to help them in any way that I can. So what you're doing is a way to help them. Chris, I need a commitment from you. I need a commitment that you'll look for any opportunity you have, even if it's not directly tied into tax side and to taxes, and you'll do anything and everything you can to support small business owners. So with that kind of mandate, when Devin came to us with this idea for the Business Accelerator, and with what he was already doing with the Business Accelerator for us to partner with him, it became a no-brainer. It's why Kevin's going to be here virtually live tomorrow. I don't know if Devin's shared that with you yet, hopefully he has. We'd love to get questions from you. Please get them to Devin today so I can have them before I start with Kevin in the morning. But he's here because he believes in what you do, and we're just super appreciative, not just to have you here, but for everything you do to make this country great. So just thanks for being you, and thanks for being here. I want to hit a couple things today, maybe lay the groundwork for today. So I want to talk to you about a little bit about what you need to know about taxes. I'm going to share with you a little bit about what we do for you. But candidly, I'm going to punch you in the face just a little bit, hopefully with your permission, to make sure you understand what you need to do too. Does that sound fair? I want to talk about the right way to think about taxes, and then we're going to spend some time actually talking about commonly missed deductions. My goal here for the next, call it half hour to 45 minutes, is just to hit you. So don't raise your hand, I will just rudely ignore you for the next half hour to 45 minutes. Here's why. What I want to do is I want to grease the wheels just a little bit. And what's going to happen is if you have questions, I'm hoping to spark some thoughts, I'm hoping to spark some questions, and then I'm going to bring Gene up, and Gene and I will spend an hour or so answering questions. So this is kind of the prep work to go into the next phase, where we're going to spend some time answering questions, and we'll give you the time that you need to answer the questions. Does that sound fair? So let's just talk a little bit about what the tax code is, and I think it's really important to understand this piece. Way too many people just think that the taxes are what they are, and I'm going to pay what I'm going to pay, and there's not a lot I can do about it. It couldn't be further from the truth. The tax code was written to incentivize you. You're an entrepreneur, you're a business owner, believe it or not, it was written to drive your behavior, to fuel your behavior. The reason is this. I know we see on CNN or Fox, I don't care who you watch, different angles, same story, but when you look at this, the people behind the politics, the people that don't think about their kind of forward-facing thoughts. Back behind closed doors, they all know this. They know that you account for 2/3 of all new job growth in this country. Whether anybody admits it out in public or not, they all know that this is the lifeblood of America. They also know 40% of economic activity comes from you. We saw this during COVID, right? It wasn't the Googles of the world that got hurt during COVID. It was the small business owner. That was where the jobs lost. That was where the economic activity was lost. And it's because truly you drive the economy in the country. So on the flip side of you and I, we have the IRS. What's their job? They're a debt collection agency. Their job is to collect every single penny that you and I owe. I'm going to tell you something that a few of you might laugh at, but I actually don't have an issue with the IRS. I don't view them as the enemy. And the reason is this, they've given me the playbook. Like, the IRS isn't going to make me pay money that I don't owe. They just aren't. The issue is that most of us don't understand the playbook or the rule book well enough that they've given to us, so we end up paying dollars that we don't have to pay. Because they're going to take what's theirs. But as long as we play the game right, we're good. I don't know many oppositions, right? We got the Super Bowl coming up, any 49ers fans? There's like 3 of us in the room. The rest of you are cheering for the Chiefs. How great would it be if you were the opposing team, you had the other team's playbook? Well, that's what the IRS has done. They've given us the playbook. They've written it, it's out there, it's thousands and thousands of pages long. But there's enough in the playbook that you and I can do things the right way and save a lot of money. We don't have to play in areas that we don't need to be in. There's no reason to be afraid of the IRS. Let's just do things right. I wanted to know how we were doing, and you can get all the stats on how we get this from taxside.com if you want to go look at it. So I had my team audit last year's tax plans. I wanted to know what were we actually doing to help clients save money. These are the real numbers audited from last year. You'll notice clients doing less revenue, we find less money to save. It probably shouldn't be a surprise to you, right? If you're doing under $100,000 in revenue, on average, we're finding $15,000 in savings. On the flip side, over $3 million in revenue, we're doing over $200,000 in potential savings, and that's with me taking our top 10% savers out of the equation because that really throws that number up. My point in sharing this is these are real dollars to you. So our goal is to put a tax plan in your hands with real strategies to help you save money and keep those dollars. I don't know about you in this room, but regardless of where I'm sitting at on this range, I can figure out something to do with $42,000 or $105,000 that I think would do me and my business a whole lot more good than the IRS. It's a really quick way to improve your bottom line and save money on taxes. So, I want to tell you a story because this is going to lead into your obligation here just a little bit. I grew up in the 90s, and I watched the Chicago Bulls obliterate the Utah Jazz multiple times in the finals. It was a rough few years for me. And I remember growing up and ridiculing Phil Jackson. I still believe, and I'll argue with any of you if you want, that Michael Jordan's the greatest player ever played the game. And he had a great team around him. He had Scottie Pippen, right, Dennis Rodman, Steve Kerr, Cartwright, you can go through the list. But I always made fun of Phil Jackson with comments like, he's just got the easiest job in the world. He's got a courtside seat to watch the greatest player play the game. And I remember as a 17 or 18-year-old saying things like, I can coach this team to the championship. And I really believed it, right? Like most 17 or 18-year-olds. I really believed it. Well, there was a show that came out recently. If you haven't seen it, write it down. This might be the most important thing I tell you the whole time. It's called The Last Dance. It chronicles the Bulls' final championship season. And you don't have to be a basketball fan. My wife, who's legitimately a ballerina, runs a ballet studio, sat down and watched The Last Dance with me, loved it. It chronicles their final season. And there's a lot of interesting things that happened. I began to see the brilliance of Phil Jackson in this documentary. You see, Phil understood his team's strengths and weaknesses better than anybody. And Phil was ahead of his time. Phil was scouting the other team and understanding the opposition in remarkable ways as well. So what did Phil do? Phil went to work and Phil put a game plan together for his team. And that game plan wasn't just based on their strengths, it was based on what the opposition gave them. So game to game, series to series, Phil would make adjustments to put his team in a position to win. There's a story in this show that's pretty funny. Dennis Rodman was part of this team in the finals. And if you guys will remember, Dennis Rodman's a character, right? Well, Phil knows that they need Dennis on his A game to win. And Michael Jordan, as you can imagine, is a driver. I mean, this guy is relentless. Phil decides that Dennis needs a break. So he sends Vegas off to Phil Jackson's party for a weekend to get a little break before the final, or before the playoffs. Michael loses his mind. You might have to mute the TV if you're playing with your kids. There's quite a few F-bombs that get dropped in that portion of the show. And Michael was so upset with Phil. How dare you send him away? We're running into the playoffs, the most important time of the year, and you send him away. Dennis disappeared. Dennis at the time had Carmen Electra as his girlfriend and didn't come back. They actually had to send people to drag him out of the casino and bring him back to the team. But something amazing happened. Dennis came back, and Dennis had an incredible playoff run. And as we all know, they won. Now, there's a couple interesting things about basketball and about life in general that I want to liken to taxes. So this is going to hopefully help you understand a little bit about what you need to do. Number one, as great as Phil Jackson was, and I think Phil Jackson was brilliant, he still didn't replace the players on the field. They were playing the game. They were involved in the game. They had to take the shots. So we're going to give you a tax plan. You already have a tax plan. It's a great tax plan with specific instructions on how to do things to save money, but you're going to have to do things. The way that the tax game works isn't a magic box somewhere that nobody else knows about to check. You've actually got to do something. If you're going to use the Augusta rule, you actually have to hold a meeting in the house, and you actually have to pay yourself for the use of the house. It's not a lot, but you have to do something. And so I hope that just everybody understands first and foremost, you have to be engaged. If you're going to save $30, $40, $50, $100, $200,000 on taxes this year, you actually have to do things differently. You are the players of the court. The second thing, though, is that it has to be done in season. Once the champion was crowned, there wasn't a whole lot that anybody could do to change the outcome of the games. So here we are sitting in January, almost February 2024. When we go, or if we go to do your taxes, there might be a few things that we can do in hindsight to unwind some stuff from 2023. But the vast majority of the tax code isn't looking backwards. It's not stuff that we can go back and do. It's stuff that has to be done during the season. So think of January 1, right? We're in the first quarter of the new game, the first quarter of the new season. What we're doing right now is what's going to impact us when it comes time to do taxes next year. So again, there's a little bit of stuff that can be done in hindsight. You have to change your perspective. Looking out the front windshield, what you're doing now is going to impact what you pay next year. There's no two ways around it. So I want to give us some crash course on some strategies. Is that okay? Again, if you have questions, write them down, and Gene and I, and maybe we can drag Will in, we'll answer some questions for you. There's two ways to do the home office deduction. The first way is the simplified method. It is simple, it is easy. I get $5 per square foot deduction for my house, up to a maximum of $1,500 per year. We see people use this all the time because it's easy. I have a 200 square foot office, I get $1,000 off on my tax bill, or off of my taxable income. Life is good, it caps at $1,500. It's easy, it's almost always wrong. The regular methodology takes just a little bit more work. Remember, you're the player on the court. It takes just a little bit more energy, but typically produces significantly more savings. The regular methodology tells us we have to establish a business use percentage of my office. Well, that's pretty easy. If I have a 2,000 square foot home and a 200 square foot office, my office is 10% of the total square footage. So now I've established 10% business use. This is going to allow me to start deducting direct expenses, but also a percentage of indirect expenses of additional things. Now, there's a couple things you need to know. Number one, the office has to be devoted to business use. What I mean by this is, I've got 4 girls. We can't run the business out of the dining room, and then when they get home from school, clear it off and have dinner at the table and call it our kitchen. It doesn't work. It's got to be devoted for business use. Number two, it's got to be a place of regular business. Now, there's a lot of things I don't like about COVID, but this is something that was really good that came out of COVID. Doing business from home became super normal. This doesn't mean I have to have people into my home, right? But if I'm tuned into something virtually at home, am I conducting business? Yes. If I'm working from home for a morning, answering emails from home because my team here won't leave me alone when I show up in the office, I'm conducting business from home, right? There's a lot of different ways to conduct business from home that have come in the last couple of years. I'm going to bet that if you get creative, almost every single one of you can think of ways to regularly conduct business from home. Here's why this matters. So this is Sarah, this is a real client. Sarah was able to establish a 9% business use percentage of her home. This allowed us to take a percentage of all sorts of fun expenses. Now we're able to take things like real estate taxes, mortgage interest, utilities, even a portion of improvements. Some improvements we can't use, but think of it this way. If I were to replace my roof, which I have to do this summer, I can't replace 90% of my roof, right? I got to replace 100% of the roof. Therefore, I can take a percentage of that roof as a deduction. Equipment, furniture, all sorts of fun things. It equated to a real deduction of $6,273. It was a little bit more work than the simplified method, but it equated to a significantly larger number that we're able to deduct from taxes. Let's talk about the S election. So Bud talked a little bit about this, I believe. How are LLCs taxed? A lot of people think that LLC is a tax entity. It's not. An LLC is a legal entity, but we have to tell the IRS how to tax it. Do we want to be taxed as a sole proprietor, a partnership, or do we want to establish some type of corporate structure and apply the corporate tax law to our LLC? That's one of the brilliance of this. It's kind of this chameleon that allows us to choose how to be taxed. So when and why? Typically, I want to take an S election if I'm making more than $30,000 a year net income. So the minute you start making more than $30,000 a year, you should be looking at moving over to an S election. The reason is you're going to reduce self-employment tax. You're going to avoid self-employment tax as you move over. So you get a lot of questions about how do you do this. First and foremost, when you set up your LLC, at the point of setup, you can establish it as an S corp. The challenge is that most people, when they set up an S corp, they didn't know whether or not they were going to make money. So they didn't, when they set up an LLC, they didn't know if they were going to make money or not, so they didn't take the election. So the beginning of every year, you have 2 months and 15 days. There's an open enrollment cycle. You can change and say, hey, right now, where we're living, right now, January the 30th today, whatever it is, I'm in this window where I can choose to be taxed as an S corp. There's also what's called a late election, which is typically where we see people take. What they do is they start making money and they realize, oh shoot, I'm not an S corp like I need to be. There is a form that we can fill out. It's a late election form. Gene hates it when I use terms like we always are able to move over. The vast majority of the time, the IRS will approve this if you turn it in right. A couple things you need to know. Number one, you've got to put yourself on payroll. We get a lot of questions about this. You have to pay yourself a reasonable compensation. So now I've got to start taking a W-2 wage out of this business. That could be weekly, that could be once a month, whatever it is. I've got to take a W-2 wage that's reasonable. I've got to file 2 returns. I want you to realize this though. I actually just had my team talking to somebody today, and he was filing as an S corp, and his business was profiting about $200,000 a year, and he was taking $180,000 in W-2 wages because he wanted that money. We need to live on it, right? It's the wrong thing to do. We typically want to pay ourselves as little money as we can justify on the W-2, and we can still get our money on the profits or distributions. But that difference is where we save the self-employment tax. That difference is where we pick up the tax savings. So we want to justify as little W-2 income as we can, but still being reasonable, and taking as much as we can through distributions. That's where we pick up the tax savings. Again, real world example, nothing crazy here. This is Austin from Texas. Taxable income a little under $50,000. So again, this isn't a huge number. If taxes is Schedule C, you would have paid $7,400 in taxes in self-employment. By changing over to the S election, that went down to $1,530 for a difference of $5,885. Now, note that isn't a reduction in taxable income. That's real savings right to the bottom line. That's real tax savings that you would have paid to the IRS had you not taken the S election. Again, remember, you need to file 2 filings, your personal and your corporate filing. Let's look at the Augusta rules. Everybody's favorite because it sounds fun. It's an easy one. It tells me that I can rent my home out and not claim the income. I can do it up to 14 days per year. The real place that this gets fun for us is that our business can rent the house from you. So you can take your home, hypothetically, you can put it on VRBO or Airbnb or in your local newspaper if there's such a thing anymore. And you could rent it out for 14 days a year and you wouldn't have to claim the income. The story is, and I don't know if this is true or not, in fact, Gene likes it when I call it Rule 280A, that's what the IRS calls it. But the story is that there were so many people down in Savannah, Georgia, that when the masters came to town, they could rent out their homes for obscene amounts of money. And they didn't like paying tax on it. So they went and lobbied, we got this rule passed, I can rent out my home for 10 grand a night, make $100 and some odd thousand and not pay tax on it. Now, I don't know if that's true or not, but it's a great story, right? But the principle applies. The reason that this gets fun with our business is, I don't know about you, but I'm not going to get my wife and kids to move out of the home in 14 days a year. That's not going to happen. So what I can do is I can actually have my business rented from me. Now, it's got to be for a specific business purpose. If you're an S corp, you need to have board meetings. So you can use it for board meetings. You can use it for a marketing retreat that you do. You can use it to host people that are in and out of town. You can do different things with it. It's got to be for a specific reason, and it must be in line with the going market value rates for a similar venue. Now, here's where I lose a lot of people. People will tell me, hey, Chris, I've got a 4-bedroom, 3-bath home, and on VRBO, I mean, I don't live in Augusta, Georgia, and it said Savannah, I didn't say Augusta, sorry. And I can only rent it out for $300 a night. That doesn't sound like a very good deal. Well, write down this website, write down peerspace.com, P-E-E-R, peerspace.com. This is VRBO for office space. When you go to peerspace.com, you're going to look for a boardroom in your state. Don't look at your city, look at your state. When you look at your state, you're going to also change the dollar value. You can adjust the dollar value to call it $175 to $300 or $250 per hour. and it'll pull up a whole list of properties, unless you're in a few states. Gene can probably tell you, I think North Dakota, there's some problems there. If you live there, sorry. The rest of it, you're going to be able to find rates that are going to justify, in our mind, the right number is about $1,600 per day. So $1,600 per day, we don't have issues with the IRS taking back on this. This is how it really works. Chris from Washington, rented the home for board meetings. Again, peerspace.com, we're able to justify $1,600 a day. Gene and his team likes to recommend 12 meetings per year. That's a $19,200 tax deduction using one strategy. Let me just explain to you why his team's going to recommend 12 days. You can use up to 14. There's a little caveat to this rule to be aware of. That maximum of 14 days is per 12-month cycle. It's not per calendar year. So if I go 10 days in September, October, November, December, and then 10 more days in January, February, March, all of a sudden I'm over the 14-day window and all that money becomes taxable. So Gene's team likes to say, hey, do one meeting a month, 12 times a year to make sure that we stay under that 14-day number. But know that you can't go up to 14 days, but it's in a 12-month cycle. You just got to make sure that you don't cross over in the 12-month cycle, that 14 days. Hiring kids, this is a fun one. You can pay your kids up to $13,850. Gene, is that going up this year? 14.6. So 14.6 in 2024. The kids have to perform legitimate work, and the compensation again has to be reasonable. So what can they use the money for? Again, Gene hates it when I say things like anything, but just about anything, right? They can use this to pay for sports, dance, school clothes. They can put money in an IRA. They can do all sorts of fun things with this money. Now here's the issue though, the kids have to perform legitimate work. So what's the legitimate work that they can perform for you? They can clean the office, wash the company cars, update the company list, all sorts of things. I think you gotta be, I don't want to say careful, but you just gotta be aware here. If I've got a 3-year-old, paying my 3-year-old to clean the office probably doesn't pass that sniff test Bud talked about, right? But I'll tell you, as I mentioned, my wife, right, runs a dance studio up in Alpine, Utah here. And our kids, every single one of them is dance. They haven't had a choice. That is what they do with their life, right? Well, a number of years ago, they needed models to put new pictures for brochures, for competition. In fact, my daughter's face is still plastered in like 10 feet tall cutouts around the dance studio. And they brought in a bunch of young kids for models. Well, is that legitimate work that a 3-year-old can perform? For sure it is, right? That's absolutely legitimate work. So just think through what's a legitimate contribution your kid can make and let them go where they do. I want to hit just a couple, I don't want to call them more aggressive, but more sophisticated, more advanced strategies, particularly for people earning higher income. And then we'll jump into G. Partnership deductions, these are typically for accredited investors. So this is typically for people that are making some decent money. The benefit of them is they get a large write-off while holding an asset that hopefully is going to produce a return on it. So I got to tell you, there is risk involved. You're putting money into an investment. So think oil and gas. This is a strategy that people have heard before, oil and gas. If I put money into the right kind of oil and gas investment, I get some benefits here. The first benefit is that when done right, I'm able to get a large deduction. Now, in my mind, this is a great strategy for people that for one reason or another don't like a qualified retirement plan, or maybe they've tapped out a retirement plan, they're looking to put some more money aside. I don't get a dollar for dollar deduction like I might with a qualified retirement plan, but I get 60 to 80% write-off. What that means is, if I put $100,000 into an oil and gas investment, I'm going to get an instant 60 to 80% written off. $60,000 to $80,000 is going to come off of my taxes. I'm going to save those taxes that I'm going to pay on the $60,000 to $80,000. The great thing about this is I can typically take that write-off against active income. But what's really interesting here is when done right, when the income comes back on it, I get to treat it as passive income. Why does that matter? Passive income rates are typically less than active income rates. So if you can see, this is a really cool strategy. I put a bunch of money in, I get a big tax deduction against active income. But now when money flows back to me, I'm able to write it off or to treat it and tax it as though it was passive income. And again, it's a great idea for those of you that either tapped out a qualified retirement plan or maybe you don't like it. I want to talk conservation easement. If you Google conservation easements, you're going to see a bunch of terrible things. So don't let that scare you. We're actually not using what is a traditional conservation easement here. But the strategy works the same. So since people heard of conservation easements, this is typically for people that are making $250,000, $300,000 plus per year. And this allows me accelerated purchase power on charitable contributions. So I know this idea is going to sound crazy, but just stick with me on it for a minute. We all know that if I itemize deductions and I take $100 and I give it to the Red Cross, what happens when I go file my taxes? I get a $100 write-off, right? It's great. What this strategy does, though, is a little different. This strategy, when I use donation strategies like mineral deposits, real estate loan donations, or art grants, that $100 donation actually becomes a $400, $500, or $600 write-off. So I'm able to write off 4, 5, or 6 times what I actually donate. Now, it doesn't really work that way because the companies that facilitate these are going to have a minimum investment. They're not really going to let me donate $100. I'm going to have to donate $50,000 or $60,000 on the low end to participate in this. But again, think about it in these terms, just to make math easy. If I made a $100,000 donation, that $100,000 donation becomes a $400,000, $500,000, or $600,000 write-off. It's insanity.
That's insanity.
Here's how this really works. And many of you might say, well, I don't want to give $100,000 to charity. You actually do it. Here's why. This is Sean from Texas. Working with Sean, we were able to produce about a $200,000 deduction with a $40,000 contribution. So when you look at that, he took $40,000. I want you to think about, where did this $40,000 come from? It wasn't money that came from his bottom line. It was money that he was going to pay one way or the other. He had a choice. Do I pay the IRS this $40,000, or do I take this and through one of these strategies make a contribution to a charity? Well, that $40,000 donation created a $200,000 write-off. So his tax savings was far more than his actual donation. So he put $15,000 cash to his bottom line. After he paid the $40,000, he saved about $55,000 in total tax savings because of that deduction. So he saved more than he contributed, and that's the only reason we do this. We don't want to make a contribution that we save less than what we contribute, right? That wouldn't be a very good tax strategy. But what we're doing is the real savings, the $15,000 savings, is the net savings after covering that $40,000 contribution. Now, Gene can sit here and unpack for you why the government lets you do this. I couldn't. I just know they let us do it, so it's a great strategy to use. Again, why does this matter? These are real dollars that are going out the window. Whether you're paying the IRS or whether you're going to use these dollars and do something different with them, these are real dollars that we believe, candidly, are better in your hands than the IRS's. We don't want to do anything that's going to get us in trouble with the IRS. That's not what we're talking about. We don't want a bullseye on our back. We don't want to play outside of the line. The brilliant thing is we don't have to. There's enough opportunity inside the tax law that if we just understand the rules and play by them, these are the kinds of real potential savings that clients see. So we hope that you'll take the plan. We hope that you'll remember that every Tuesday, Wednesday, and Thursday, with a rare exception, Gene goes live and will answer your questions in our Ask the Pros to help you implement any strategies that you might have. I hope you'll take advantage if you have a question of Will, who's sitting out here the rest of the evening to talk to you and help you put anything in place that you might have. And then what we want to do here, Satish, I'm thinking for the next 45 minutes or so, we're going to run some Q&A. And then Devin asked me to actually share kind of one thing that I don't typically share at the end here today. So we're going to run 45 minutes of Q&A, and maybe 10 or 15 minutes. Gene and I want to kind of hit a bonus item to make sure everybody walks out here prepared to tackle the taxes. Does that sound fair? Gene, you ready? So here comes Gene. Satish is going to run mics around for us. So we would ask you, and especially in a room this big, we have quite a few here, if you would make sure to raise your hand and get the mic from Satish, so A, we can hear you, but B, everybody else in the room can hear you before you ask your questions. Does that sound fair? Right here, right in front. We've already had a question.
Yes, I'll step up. You said something about
Put it a little closer to your mouth.
Okay, you said something about when you're taking square footage tax off your business. She has an office, home office dedication. This is kind of two-part situation. I've got a barn that we've finished up, and that's where I store all my equipment now. What's the best way to handle the barn? Should OCS rent the barn? Because I'm getting rid of some rental by doing that, or would it be better to take the square footage? And I'm going to tell you the second part because you might catch in. Our house had a tree drop into it a year and a half ago and took out a major part of our house, but we were able to still live in it. So in 23, we've had to fix all that, and can we take part of those expenses we had to fix it?
Great question.
So I'd avoid the rent. Oh, that's loud. Usually not so loud. I'm a quiet one. So you can definitely do both. I would not do the rent expense for the barn though, because what you're doing is creating a taxable income in conjunction with an expense, whereas if you just do the deduction, you can deduct it. So then you've really got to evaluate, are the expenses separate from the house or are they shared? And if they're shared, you would just take that barn and add the square footage of the barn to both the home office deduction, assuming you're using the whole barn. So the home office square footage and then the home square footage, so that it's hitting both of those calculations and add it in.
What do we do with the money we paid to have? I mean, insurance picked up some of it, but they're not picking up a lot of it.
Yes. So the amount that they're picking up, you can include that because it's covered. The rest of it, just allocated according to that home office deduction percentage, and you'll be able to claim it. I would be careful though, evaluate, is there something in there that is not specific to, like it 100% will not affect the home office deduction, and exclude that perhaps, like maybe a water heater or something like that, if you have to fix that. But most expenses you can.
We've got a section of roof that's leaking that's in that home office area, and that's the part that they're saying we're not going to pay. So we're just trying to figure out whatever we end up with part of the cost of removing the tree off the so.
Yeah. I would claim both of those as a percentage.
My question was about the Augusta rule. Is there stipulations for that? Like if you own A, several businesses, or B, like if you and a partner both have a business that you rent out to?
You're trying to find a way to find 28 days to write off, right? Sniff it out.
So there are some stipulations. First, it has to be for a qualifying residence, and one of the rules about the qualifying residence is that you're using it for 10 times more than the number of days you're renting it, so you do need to live in there. Like if you're doing 12 days of rental, you need a good 120 days of living in that property. And it is 14 days per property is the limit per qualifying residence. So you can't use it across multiple businesses and claim 14 for each of the businesses. You could claim it across multiple and use like one for this one for that one, or maybe 6 for 2. Just something to get up to that 14 days, but make sure you're below that 14-day limit per property. But 2 partners means there are 2 qualifying residences, probably, that could potentially use that. You just need to then cross off the other threshold of there's a legitimate business reason to be doing this.
Just think of it in the sense of per property, not per business.
Okay.
All right, I also have a question on the Augusta rule. So I recently filled out paperwork to convert my LLC to an S Corp. When should I start, like should I wait until that conversion is done to start with the Augusta rule, or can I start that immediately?
So you can start it immediately. Just make sure that whatever meeting you're holding in the property meets the qualifications for the type of entity. So the S corporation makes it super easy because it's required by law to have board meetings. So you just need to select a board and then hold those meetings. If it's not an S corporation, we've had a fair number of taxpayers who've had this disallowed. But when you go look at it, all I've ever been able to find is that the reason is they're holding board meetings for a single member LLC that's a sole proprietorship, and they don't have a board. So just make sure the meeting meets the needs of the business, and you're not holding board meetings for a single member LLC.
Okay, even if I'm a single member S Corp, I can still hold the meetings, however?
Yes.
Okay.
Just make sure that you select a board. Often we'll pull in a spouse or a family member for that. They don't have to be an employee of the business. They don't have to work for the business. They don't have to be involved in the business in any way other than a part of that board, or they could.
And I would just tell you, you don't have to have a lot of documentation, but make sure you have some documentation. Let's just unpack Augusta rule for just a second here. Gene's gonna want you to have a rental agreement between you and the business. I know it's a simple little piece, but have a rental agreement. Actually make the payment to yourself. Actually record notes and minutes from the meeting. And it's not a lot, that little piece will come in handy in the event that you actually have to do the IRS. Hopefully you don't, but just a little bit of an ounce of prevention worth a pound of cure, you just need to have.
Okay, and does it matter, like when I make the payment to myself, like I'm fully self-funding my business and bootstrapping it, and I'm going to have to put more into the business? I mean, is it okay if I pay myself and then put it right back into the business?
Yes, and technically you don't even have to have the money move, but I do prefer that you do just because it closes that auto loop and makes it look clean.
Okay.
Let's go here, then I saw a question back here. Great.
Can I, okay. So Chris mentioned that in order to get more tax savings from a S corp, you should pay yourself with a W-2 and record less of a salary as possible. And he also mentioned that you should take the other income as a distribution. Did you mean quarterly dividends, or what did you mean by distributions?
I don't recommend quarterly dividends. As an S corporation, that's technically allowed, but I wouldn't do that. I'd do the distributions because the dividends are taxable.
Can you unpack the distributions?
Yeah, distributions is just like in a sole proprietorship where you just pull money out of the business, and you want to keep it below your basis, which just think money I put in plus the earnings of the business minus money I've taken out, that's my basis. Not perfect, but close.
So like an owner's draw or something like that?
Yeah.
Okay.
Yep.
Gotcha, thank you.
Let me just make one mention about this too while we're on it. There's another great website, rcreports.com.
Yes.
rcreports.com. If you're wanting a little more backing for what reasonable comp is, RC stands for reasonable comp. You'll pay a little bit of money up on the current going rate. You'll pay a little bit of money, maybe a few $100.
Yeah, I'm not sure what it is right now either, frankly.
But basically, they will help you put together a report justifying the reasonable compensation you come to. You don't have to have it. It's just a nice little tool to help you figure out where you should come to reasonable comp.
Hi, my question is also about the board meetings. What needs to be the content of those board meetings?
So the board meetings can really include anything that you need it to include for the purposes of your business. So you can talk about finances, for example, and how to grow your business. You could have a board meeting that goes over marketing and how to do marketing better. You can do a sales meeting and how do you get more out of your sales team. You could also use any of those as, like, you could bring in your sales team and have an official sales team meeting or an official marketing meeting. Just whatever you would need to go over that you would typically go over in a board meeting. And think of a board meeting as basically the executives or the decision makers getting together and figuring out how to keep this business healthy, strong, and growing if desired.
Thank you.
I think the only thing I'd warn just a little bit about meetings in your home is entertainment is no longer deductible. Hopefully you guys are all aware of that. So holding a Super Bowl party in your house with your board would be a little harder to justify if you call on it, right? But if you're meeting and discussing any of these kinds of things, you'll be just fine.
So even if you own the building in which you operate your business out of, can you still use your home for special occasions like staff parties or Christmas parties and things like that, and then use both?
If you want to use the Augusta rule, yes. So the commercial property or the business location technically cannot be used for the Augusta rule because it is not a qualifying residence.
But hypothetically, could Gene and could tax hike pay me to use my home? Yes, even though we've got a building here.
I have 2 LLCs running out of my homes, and we have 2 separate home offices, but we also have a shared space, like where the printer is, we're sharing the printer. How do we track that for home office deduction purposes?
So I assume that each business is claiming one of those plus half of the middle. So I would just allocate it, okay, this room is this number of square feet, this room is that number of square feet, and then the shared space is X number of square feet. So this one gets 50% of the shared plus its space, and the other one gets 50% of the shared plus its space. And more likely than not, they're about the same square footage, but
There you are.
might be a
Okay.
little different.
Perfect. Thank you.
You bet.
See right in front of you. You have a question?
So I have a single member LLC as one of my businesses, and I recently took y'all's advice and moved it to an S corp, operating as an S corp for tax purposes. Does that mean that I have to do a board meeting even though it's only for tax purposes?
So they are required by law. However, there's no stipulation on how many you have to hold. You could hold one per year and be just fine. But I recommend you do the 12 and take advantage of that Augusta rule.
Okay, because I was thinking just because it was for only tax purposes, I didn't have to do that, so I misunderstood that part. Okay, good to know, thank you.
You bet.
It's a teacher earning your money today.
All right, so I'll go away from home office. I want to go to conservation easement.
No,
So I know it's a listed. We'll do another home office question. So conservation easement, I know it's a listed activity. I know it's getting a little bit sketchy because even people I know that do this strategy don't want to do it. How are you guys? You say you're going to do something different with it, or a little simpler method. What's that?
Yeah, so when we talk conservation easements, we're usually talking about a category of strategies. And the traditional conservation easement from which it gets its name is the one that's the targeted strategy you're talking about, but the other ones are not. And the reason there is the conservation easement itself, super easy to abuse it, and it has been abused a lot. The others, very hard to abuse them, and so they're not targeted strategies. Having said that, if you ever get into a situation where somebody's coming and telling you that you can write off 10 times your investment, run from it. They're wrong.
So if you notice, in fact, if I just go back to the slide real quick for you, when we looked at conservation easements at the bottom of the list there, mineral deposits, real estate loan donations, art grants, that's not the segment that's getting the scrutiny. It's the way that real estate is being used in conservation easements that's getting the scrutiny. So we wouldn't send you down that traditional path. Gene's team's going to recommend you use these mineral deposit donations as an example because they aren't under the same scrutiny. Because they're much more difficult to actually pull off into the right way.
Rather than just land.
Correct, exactly right. Exactly. Not that you can't use land, but as you pointed out, it's a hot button right now, right? Because it has been taken advantage of. Although some rules are changing on it to try to bring it back in line and make it a viable strategy. But for now, we would recommend you play this other lane rather than kind of traditional lane.
My name is Maurice. My wife and I, we file married filing separate. I have my property, she has her property. We live in her property, and my home office is in that property. Can I still write it off as home office?
Yes. Just make sure you've got the documentation to support it. While you have that, when you're done with your question, can you pass it forward one to the gentleman in front of you? He's raised his hand a few times.
Quick question on the Augusta rule. Does it only apply to property that's in my personal name? If I have a home in an LLC, also?
As long as it's a qualifying residence, you can use it. So it doesn't need to be in your personal name, but there does need to be that personal use component that we talked about.
Again, if you Google this, you'll see lots of people tell you that if you're renting, you can't use it. That's not the case. So if you're renting, we're okay with you using it. Online, we'll have people tell you all sorts of different stuff, but if it's your residence, whether you're renting it or own it, we would tell you to go ahead and use the Augusta rule.
It's an LLC that I own. Did I create a taxable income?
The Augusta rule avoids the taxable event. Up to 14 days, we don't have to pay the taxes. Up to
So
14 days, we do.
the one concern I have here, though, is we're talking about an LLC or a rental, or excuse me, a property in an LLC, is that as long as this is your residence, you're living there, you're not renting it out for other purposes, this works. But if you're renting it out for other purposes, you're going to exceed that 14-day mark, and it's not going to qualify. So if this is a rental LLC, then no, this doesn't work. But personal home owned within an LLC, we're fine.
The second home that I own.
Yep, that's fine too. As long as you live there enough to qualify.
Okay, I'm trying to wrap my mind around all of this, as I'm pretty sure you know this is a lot to digest. I just got an apartment that I would like to use it as a place of business. I'm only 3 months into the lease. I'm just now learning about this, that you can have, you can write off space for business in your business. Is that something I can do even though I did pass the 14 days that you were talking about?
Yeah, so there are two different components. There's the Augusta rule that you can do. Just know that sometimes when you're operating the business out of the residence, the IRS successfully argues that it's actually a place of work, not a place of residence. There's ways to fight that, but just know it's a little bit more risky. The other one is the home office deduction. So you have the two that you can do, the Augusta rule and the home office deduction. The home office deduction is where you have the square footage set aside for regularly and exclusively using it for business. It's a little bit more difficult in an apartment, but as long as you do have that space set aside, you can claim that home office as well. And it doesn't have to be an entire room, it can just be a corner of a room. Just make sure you're claiming the square footage and that it is regularly and exclusively used for business.
The whole entire 1 bedroom is exclusively used for business. I moved in with my mother so that money can allocate towards my business. So I don't live there.
Okay, that definitely works then.
Think of it in terms like this. Think of these as two separate things. If I have a home and part of it is used for the business day in and day out, that would fall under the home office deduction rules. Then that other portion, I could rent out to my business up to 14 days and use it for the Augusta rule.
Okay.
So kind of think of it as almost two separate pieces. I've got the office that I'm using day in, day out, and then I've got where I'm living. I can rent that to the business and get the Augusta rule and pick up both.
As I'm thinking about this, is probably your office space entirely, right? Because you just said you don't live there.
I do not live there. I purposely signed the lease with the landlord in the building, and I'm using this specifically for my business. I do not live there.
Yeah, so don't even worry about the home office deduction. Move towards what he's talking about with this is an office space, claim all the expenses. Don't allocate, just claim it all.
Okay, thank you.
So having a single member LLC, obviously don't do member meetings there, can't do a board meeting because it's not an S corp. But I do have a bunch of subs that work for me. Could I do subcontractor meetings for business development and still use this Augusta rule?
Yeah, as long as they're legitimate meetings for a purpose and you keep track of some sort of meeting notes or something, yeah, that's fine.
If I rent my house to my S corporation, if I rent it to myself, is that ordinary income?
Yes.
On the home office deduction, fast forward if you've taken the home office deduction, say 5, 6, 7, 10 years, and then you go and sell your home, what's the impact on the sale?
That depends. For a lot of times, if you're claiming improvements as a straight up an expense, then you are possibly depleting your basis in that property. And then if you're also claiming depreciation associated with the home office deduction, which you can do, that's also depleting your basis. But think of it like this: if you're doing those things, you're decreasing your ordinary income now and increasing your capital gains later. And capital gains rates are traditionally lower than ordinary income rates, so you're trading tax brackets, which is a good thing. In addition to that, time value of money, your money today is probably better than down the road.
So you got to keep track of what you're deducting on an annual basis to know what your cost basis is in your residence over the span of that time.
For the depreciation, usually yes. For the repairs and maintenance on it, most of us don't track those for our sales price, and so most of the time it's not a big deal. Most of us are sitting here and we're reporting what we bought the home for. We never take into account the improvement on the roof and all that other stuff when we sell our home. So it's like we didn't claim it anyway.
If you're depreciating it though, keep track of the depreciation.
Yes.
I recently remodeled our house and put a whole room on the end of our new house for my business. So I claim the home office credit. But part of that space is big enough that I have a pool table and stuff in there. It made me think of when I saw your guys' gym equipment over there. Could I take that whole room off the end of my house, make it business use, and have staff meetings, and that's, team development, that sort of stuff, even though there's like a pool table in there? Are they gonna call that entertainment and use for my family?
So if you were to use that space only for business and the pool table's there for employees and stuff when they're coming over and you're not going in there using it yourself, you can do that, but you're going to have a hard time proving it. So I'd probably avoid this just because the burden of proof is not going to be your friend, unless you have a way that you can really prove this is never used outside of business.
Perfect. And then how do you guys look at, it's on my personal property again, but outside buildings that are used for business purposes?
Yeah, that goes back to the burn earlier. I would claim those if they're regularly and exclusively used for business, and then I'm looking at, can I segregate the costs easily so that I can say, I have 2 bills here for utilities, and one clearly goes to this building and the other clearly to this, and I'll claim 100% of that, that's just that. But if I can't, then I do an allocation where I pull in that square footage into the calculation of both the home office space and the total home space. Yes, just know that sometimes this could work against you. For example, if you have a garage space you're using and your total square footage of your home is about 1/4 of the home that you're using for business, but then it's only 10% of the garage, that might work against you, might be a reason to leave it off. So evaluate which one's better.
If I have an S Corp and if I need to raise loans and mortgages, what figures on the 1040 and 1065 should I keep my eye on so that it does not go too low?
So you're paying a loan for properties?
I want to raise capital.
You want to raise capital?
Yeah, through loans, mortgages.
Okay. And the raising of this capital is entirely for the purposes of the business? Okay, I claim 100% of that expense on the business, 1065, and none of it on the personal side.
Okay. One more question. Are there other do's and don'ts that you would recommend when one of my businesses is investing in another business owned by myself?
So you have one business that is not listed on the business. I'm sorry, I'm having a hard time saying it.
Both my businesses are LLCs.
Okay.
One is I'm taking the profits out of one and investing in the other.
Okay.
Are the do's and don'ts that I should think of? Capital gains, how to register or whatever.
And so that one's recorded as a loan, you're saying, from the one business to the other?
I could treat it any way. I could treat it as capital investment or give it as a loan.
I think the question, kind of maybe frame this up what I think you're asking is if it on that. I've got profits coming from business A and I want to put money over to business B. Recommendations and things I should be thinking